Okay, so last class, we introduced the lease, and the lease is a agreement between two parties. We have lessor and we have leasee. Lessor has an asset or property that leasee would like to use. So lessor would let the leasee to use the assets in exchange for some consideration. So that's a arrangement. So today we start talk about the lease accounting. So the first thing we need to talk about today is that who set rent and based on what. Okay, so that's determine the lease rental payment. Determine the lease rental payment. Okay, so from lessor's perspective, okay, so this is the business model. Lessor has funds and he seek to invest these funds in certain properties that the lessor knows they can lease. There's a need to lease it. And so therefore, from the investment lessor is going to make in this property, it's going to lease, he will expect to earn a certain return. And so lessor would set lease payments, rental payments at such a level that allow him to earn that return. Okay, so rental payment, you know, from our perspective, would be the amount that allow lessor to earn the return that for its investment. Okay, so the lease, the rental payment is determined. Yeah, I think I fixed that, right? Yeah, the mic is okay now. I think that's something else. So the lessor determines the rental amount based on the rate of return expected. Now this rate of return would have to do with you know, leasee's credit readings, you know, how risky it is, the likelihood of default, the loss on default, the length of the lease. Usually the risk increases the longer the term, right? Whether there will be a residual value and other considerations such as income tax. So the investment to be recovered, in addition to the purchase price of the property, there's also a you know, some initial costs, legal costs, initial related to negotiation, so on and so forth. This can all be included in the investment to be recovered. If there are residual value, like if the leased equipment to be returned at the end, or if there is a purchase agreement between the lessor and the leasee at the end of the lease term, and it's likely to be executed, then that amount should be deducted. The terms are a bit different. Under IFRS, if you have a purchase agreement at the end of the term, and if there's reason for you to believe it's likely to be exercised, usually that if the price is better than market price, right? That then, you know, we say the purchase option are more likely than not to be exercised. The same condition under ASPE will be called if there is bargain purchase option. But essentially, they were talking about the same thing, right? You have this agreement that leasee can exercise, and we, for one way or another, we assess how likely that option will be exercised. So the term to express that likelihood is a bit different. But from an accounting perspective, that has the same implications. Okay, so this is two examples. This is the first one. Say lessor expects to earn a 10% return on the 100,000 investment in an asset that is to be leased for 5 years. Annual rent is due in advance each year. So this is the common practice that, so that's why we will be using a lot the annuity due table rather than ordinary annuity table, right? So that, just like it's a silly, like higher risk. You let people use it for first before you get paid. So then you have to chase them, right? So the common practice is just you pay upfront for each period. There is no purchase option, bargain purchase option, or residual value. So basically, from the lessor's perspective, you invested 100,000. And you're going to lease it for 5 years. At the end of that, there's no residual value. So this equipment, it will be like useless anymore, right? So the only source of your return to cover your investment will be through rent. Okay, so therefore, the rent of 5 years should have a present value of $100,000 at a discount rate of 10%. Right? That's the equilibrium, right? If I discount all the agreed rent payment to present value, add a 10% discount rate, then the present value is the same as my investment, then that implies I earned 10% return. Does that make sense? Right. Okay. So that means basically the payment multiply the present value of annuity due with the parameters of like a 10% discount rate, 5 periods, 5 payments should be 100,000. So the payment should be 100,000 divided by that present value factor for annuity due. And that if you look it up in the table, or I think it's the A5, I believe it's A5. Or if you look it up, you can use your financial calculator, or you can use Excel if you're talking about assignments. You can use Excel. So that's 4.16986. And so the payment should be $23,981.62. That's each payment. So 5 of those payments give us $119,908. So what does that mean? That's more than $100,000. Yes. So the total interest is going to be 19,908, right? So we know the relationship from present value to future value. We call that process compounding. From future value to present value, we call that process discounting. The difference between the present value and the future payments is the interest. Right? So there's the total payments in future, gradually, this is in annuity terms, the future payments together is 119,908, and the present value is 100,000. So the difference is the interest. Okay, so that's how the rent is set. So now I do have the quiz ready, but I just want to see how much we can cover today. I don't want, like, sometimes the progress is not entirely predictable. So I just want to make sure, like, of the questions are from the part that we can cover today. Okay, so this part, IFRS and SB are quite different. So we will start with the IFRS 16, accounting for leasing. Okay, accounting for leases. So under IFRS 16, which became effective for the accounting period start after January 1st on or after January 1st, 2019, so it's fairly new. Use this contract approach. It says the definition of the lease is such. First of all, if a contract is or contains a lease, if the contract conveys the right to control the use of an identified asset for a period of time in exchange for considerations. Okay, so if a vendor, for instance, lease the location 105 in the airport and for 3 years for a monthly $500 rent, that's a lease. Because first of all, that a particular part of the assets is the location 105, that's a store space, for a period of time of 3 years for a rent of $500 per month. Similarly, if you go to airport, sometimes you see this little cart kind of thing. If you said, well, the vendor has a permission to sell the merchandise in that cart somewhere in the airport, that's not a lease because there's no identified property, okay, in that contract. Just that you can sell it, but depend on, we tell you where you can do it on a certain day, right? That is not even considered a lease. So this is identified asset for a period of time. Now, this period of time can be substituted as extent of use, like that. So, sometimes you for instance, like if you lease a truck, deliver the goods, and then they may restrict the mileage, right, instead of the time. So you just need a trip. Okay. If a contract is or contains a lease, but it has other components in the contract, so we have to separate. Usually the service components is not treated as lease. Service components usually is treated as executory contract. Executory contract means something you are going to execute, and you will record it when they are executed. Okay, so all leases, this is the most significant provision in this IFRS 16 is all leases are capitalized except short-term lease less than 12 months or low value lease. Okay, that's a little bit of judgment to be exercised. Okay. Okay, so that's if a contract has a lease in it, the lease should be capitalized in most situations except low value short term. So that's it. Okay, so the initial measurement of the lease. So all the leases except short term and low value are also called the right of use lease. Okay, the right of use kind of. So basically a transfer, not risking the benefit as the SB would focus on. It's you transfer right of use the asset from lessor to lessee, and lessee will recognize right of use asset. You see the balance sheet, that's called right of use asset and lease liabilities. So right of use, the right conveyed to you through the contract, right? Okay, so right of use asset is initially measured at a cost based on the present value of the lease payment. So in addition to the rent, that could also include the initial cost of dismantling and removing underlying assets and restoring the site. We have seen these terms. These are the same terms included when we capitalize a purchased capital asset, right? So it's just very similar. So right of use asset on the balance sheet is for analysts, for users' perspective, have the same characteristic, treated the same as PPEs. In fact, they are listed as a component of PPEs. Right of use assets is listed as a component of PPEs. So that's the liability is measured at present value of lease payment, taking into consideration of variable payments, terms of the lease, and these will be discounted future payments. Use the discount rate we mentioned. Okay, and so this discount rate, okay. Okay, so let me mention that this discount rate lesser use is called the implied implicit rate or lesser rate. Okay, implicit rate or lesser rate. Okay, so subsequent to initial measurement and recognition, lease liability will be treated like a long-term debt. Okay, it will be treated long-term debt. Interest will be accrued onto it, and the payment would be considered a part for interest, part for principal. The amount above beyond the interest will be the reduction of lease liability. Okay, so that's using the effective interest method. Right of use assets will be depreciated using the similar approach companies use for their PPE. Most times in this course, we use straight line, but you don't have to restrict that to the straight line method. Okay, so let's look at now this lease terms. Let's go back, talk a little bit about lease terms. Lease terms include the initial term of lease. Some lease have renew options. So the renew option that's likely to be exercised will be included as well. Okay, especially, you know, the real estate, like a lot of times it's renewed automatically unless things change, right? Business don't like changing locations for no reasons. So here's an example of that lease with a renew options and how it is treated under IFRS 16 by lessee. Assume lessee enters into a non-cancelable lease contract with the lessor on September 1st, 2021. The signing and delivery of the lease happen on the same day. Terms and conditions of the lease. So the economic life of the equipment is 7 years. The lease term, the initial term is from September 1st to 2021 to August 31st of 2025. So that's 4 years. So for that 4 years, the lease payment per year is 5,000 in advance, beginning of the period. There is a renew option for 2 additional years, either reduce the lease payment of 4,500 per year. Okay, so expected residual value of the assets not guaranteed. This is very important. We will talk more about the residual value. Residual value is treated somewhat differently between lessor and the lessee. Okay, so for lessor, if there is residual value, it will be like automatically considered that. Did Did I skip example? Did I skip this example? Oh, okay. Yes, I think, sorry, let's go back to this, like what happens if there's a residual value, right? So this is a different example. I'm sorry, how did I skip a couple of slides? Anyways, okay, I need a break to refocus. Okay, so this is a, if there is a residual value, when lessor set rental payment, it will consider this. So for same rental payment example, we change a little bit. That's still 100,000 investment, 10% expected rate of return, 5 years lease. But this time at the end of the 5 years, the property will be returned to lessor, and then the returned property is expected to have $5,000. Okay, and from lessor's perspective, now that since he gets this used asset back, and then the used asset has a value, so part of the investment will be returned in the form of this used assets. So only the difference between the initial investment and the present value of this returned asset should be recovered from the rent. Okay, so therefore the rent will be a little bit less. So the amount to be recovered would include the initial investment, and this would be present value of that 5,000 at the end of 50 year, right? End of 50 year. So the difference is $96,895. That's is less than 100,000. So convert that into annuity due, it's only $23,237. So compared to the previous with no residual value at a $23,982, you know, the rent is a little bit less, right? Because part of that. So what I was going to say is that for lessor's perspective, as long as there is expected residual value, lessor would take that in consideration in setting the rent. Okay. From lessee, however, the residual value, if like this is the case, the residual value can be either guaranteed or unguaranteed. So what it means, if it's guaranteed, it means, well, when the equipment was returned, they will assess the value of this used asset, 5-year-old used asset. If the value is 5,000 or more, good, I will return it and that's it. But if the assessment says this asset's value is not 5,000, let's say it's only 4,000. Lessee guaranteed 5,000, so lessee will have to pay 1,000. So that's a difference. And so therefore, from lessee's perspective, if the residual value is not guaranteed, they just ignore it. They don't have to capitalize it. But if lessee guaranteed the residual value, the lessee should include the residual value in its liability, okay, and assets for that matter. Okay, so now let's say the residual value not guaranteed. If it's lease ends at 4th year, it's 6,000. The lease ends at end of 6 years, it's 1,000. But since it's not guaranteed, it's not going to affect the lessee's accounting. Okay, title to lease equipment at the end of the lease is retained by lessor. So lessor is still the owner. Okay, sometimes this title be transferred to lessee at the end of lease term. The rate implicit in the lease is 9%. So this is lessor's rate. Lessor use this rate to set rent. And the lessee's incremental borrowing rate is 9%. So if lessee has to borrow this amount with the same similar circumstances, it will have to pay 9% interest. So under IFRS, Lessee should use lessor's rate if the lessor's rate is known. Lessor does not have to inform lessee what rate they use to set rent. It's not necessary. He's not required to do that. So if lessee does not know lessor's rate, then it has no choice, right? As long as if he knows, lessee should use lessor's rate. If lessee doesn't know, you have no no other way, right? You can't force that. You just use your own incremental borrowing rate. Okay. Fair value of leased assets is 24,000. Okay, so this doesn't affect if you use IFRS, but if you use ASPEs, you should not capitalize amount more than the fair value. So there's a check. Lessee expects to take renewal option. This is important. So if we assume that, then for us, this six years lease, okay? If lessee is not expected to take the renewal option for lessee, that's a 4-year lease, okay? What the lessor expected doesn't concern us at this point. Okay, so initial measurement would include the residual value is not guaranteed, so we don't have to worry about that. But we have 6 years rent payment. That's the obligation, right? So the first 4 years at 5,000, that's annuity due, and so we look at the annuity due table with the parameters of 4 years, 9%, multiply that to annual rent 5,000, we have $17,656. Okay, and then we have 2 more payments, so they kind of treat it as a single payments, treated as 2 single payments, because so when you do the calculation, actually first time I did a calculation, I was like, forgot something myself. That's you can treat it as annuity as well, right? And if you use the annuity table, but be aware that the present value, if you just apply annuity table, that's a present value at the beginning of the renew terms, not now. So if you use that, you have discount that future amount 2 times 0. Otherwise, that will be the. So they only 2 years. So what they did is they just considered that's a payment at the end of year 4, at the beginning of the year 5. That's the first payment of renewal period, and the second one will be at the beginning of the year 6. At the end of year 5. So that's, so they got the present value of that to be $23,769. And so this is what they record. They debit right of use asset, $23,769. And so this is 2 transactions combined into 1, because the lease liability is that amount as well. But the first payment is due immediately, right? So the liability is reduced by 5,000 immediately. Okay, so combined 2 is, that's the total lease assets, and with the payment of 5,000, the difference between these, the total amount and the payment is the amount still owe lease liability. Okay, so this one again, if you want to refer back to your bond accounting, right? Because they are very similar, lots of ways, but there's minor difference. This is one, because the payment is not due until end of first interest date, right? So you just, at this one, you have a payment same day as that. And so with the little complications, like this is not beginning of the year, not the January 1st, that's what we usually do to make things easy, but it's September 1st. So 4 months later, that's fiscal year end, okay? And 4 months later, fiscal year end, we need to do two things. One, we have a right of use assets, it's like a PPE, so we need to depreciate. Two, we have lease liability, it's a long-term financial liability, we need to accrue interest, even though the next lease payment is not due until another 8 months. We still have to accrue interest, right? So depreciation computation first. Depreciation straight line, no residual value because we didn't consider residual value. It's not guaranteed. We only counted the amount we pay, right? So therefore, it's just $23,769 divided by 6 years. The fact the last 2 years, the lease is a little bit less, we ignore that. Straight line, we use it for 5 years. This is total amount we are going to, that's the cost, the present value future payment, we spread it evenly over 6 years. So it's $13,020. $1,320. There's a little bit of rounding error, probably. We don't, just ignore that for now. Oh, we're talking about in thousands, so $1 or $2 does not concern us. The interest, okay. So the initial liability is $23,769, but it's reduced immediately by the first payment. First payment, it's all reduction in liability because there's no time to accumulate the interest yet, right? So the payment is entirely the reduction of liability. So the effective interest will based on the actual balance. So that's the difference of this two. For a year, that's 9%. And we convert like a factor in that this is only 6 months later. So the interest for the first 4 months later, the interest for the first 4 months is $563. So journal entry to record depreciation, same journal entry for any PPE depreciation. We debit depreciation expense, we credit accumulated depreciation. The interest expense, we debit interest expense, that's the same as everything else. But here, instead of recording interest payable, we just added to lease liability. Okay. If you don't do it, it's not correct, but it's not really terribly wrong because it's not going to affect your total liability, total current liability. You know, it's not going to affect that. But this is how they do it, nice and neat. Okay, we're going to talk more about that, but you know, this is just give us an overview, right? We initially capitalize it based on the present value of future payment, and the liability and asset can be a little bit different if there are additional like a costs incurred, say, to prepare the sites, you know, so on and so forth, right? Can be different, but liability is just the amount you have to pay. And subsequently, right of use asset is depreciated and lease liability is amortized. Okay, so that's that. We'll come back for more just at this point. Okay, what about the short-term and low-value leases? Okay, so they're not capitalized. So assets, liability not recognized, so they're off balance sheet. Okay, so lease payments are treated as short-term and the low-value lease expense. Just payment is the expense. There's one little thing we need to pay attention is that lease rental recognized on straight line basis over the term of the lease. What do you mean by that? Okay, so here are two examples. The first one is just straightforward. So assume annual lease payment for an operating low value lease is $240. So it's actually, this operating is like the ASPE's term. Operating is ASPE term. We're talking about the IFRS. So low value is the only thing, but operating lease is the same, treated the same, right? So, so journal entry will be just low value lease expense. If it's not paid yet, we will prepaid. Oh yes, it's January. So it's a January. When the lease was paid, it would be like prepaid rent. But when we adjust it to recorded January, yes, January low, okay. To record lease payment made on January 1st. Our journal entry to record lease payment made on January 1st and recorded as prepaid rent. Okay, so that's why we don't have cash. So on January, when it was paid, it was debited prepaid rent, credited cash. Now we just recognize that any prepaid rent, prepaid insurance, you know, do that. Now, about this straight line. So here's the example why the straight line matters. So assume if lease is signed for 5 years at $300 per month. So it's a low value lease. Okay. So the first 3 months and the last 2 months are rent free. Doesn't mean there's no rent first 3 months. Doesn't mean there's no rent last 3 months, right? So those are the incentives for like, you agree to pay the regular rent of 3 months, you get those concessions. So from your perspective, you're going to spread the total rent paid over the 5-year period, as if every month the rent is same, straight line. So the total rent paid is 6 months, 5 years, 6 plus what? How did it? 5 years. I think that's not right. Minus 6 months. I don't think that's right. I think it's a 5 years minus 6 month rent at the 300 per month. That's 16,500. I think that's the 16,500 is total rent for this 5-year period with the first 3 months and last 2 months rent free. I don't know why that doesn't. Yeah, I think that's correct. Oh, this is such a. And so you divide that by 16 months, whole 5 years, you get 275. I think this amount is correct. This amount is correct. The expression is not. Okay. So that's it. This is the correct amount. This is the total rent for under the term of the lease, and spread that total amount into 5 years, whole 5 years. This is the monthly rent. I think that's correct. The expression, I'll fix the expression later. Okay, and so the rent expense to be recognized each month, it'll be 275. So that's how straight line works out. Okay, so now let's just introduce ASPE, accounting for leases. Okay, so ASPE is different. ASPE's accounting for leases is similar to the old IFRS accounting for leases that's replaced by IFRS 16. So under ASPE, this classification approach is used. Okay, so how a lease is classified, there are three tests. Okay, the first is transfer for ownership test. Who gets the assets at the end of the lease term? Okay, if the lease is returned to the lease lessor, then lessor gets the retained ownership. If lessee gets to keep the assets outright, then lessee gets the ownership, right? If there's a bargain purchase option, we assume lessee gets it because it's a bargain purchase option. It's you get a discounted price. We assume lessee will take it. So if lessee gets to keep it, lessee gets the ownership either outright or with the bargain purchase option or purchase option likely to be exercised, then that should be capital lease. Okay. Otherwise, it should be operating lease. That's just one test. There are the two more. Economic life test. Okay. Lease term compared to the economic life, it's 75% or more, then we consider that capital lease. Lease is substantial enough. If not, then it's a operating lease. The last one is recovery of investment by lessor test. The present value of lease payment, if it's 90% or more of the fair value of the assets, that's capital lease or finance lease, same thing. If less, then it's operating lease. Okay, so there are three tests. The idea is if one of the tests says it's capital lease, then it's capital lease. It should be capital. You don't have to meet all three. Okay, in order to keep it off balance sheet as operating lease, you have to fail all three tests. Okay, so the idea is if one of the tests says it's capital lease, means this lease is similar to installment purchase. Okay, like, you know, and if it's similar to installment purchase, it should be recorded similarly as installment purchase. That means you need to put the assets and liability on the back. Excuse me. Excuse me. Sorry about that. So that's the idea. Okay. So the minimum lease payment, this is the concept under ASPE that includes the rental payment, guaranteed amount, or bargain purchase option, right? These two do not exist simultaneously. If there is guaranteed residual value, that means the assets will be returned, right? If there's a bargain purchase option, that means lessee is going to buy it out. So you either return it or you buy it out, right? So you do not have these two together. You don't have to consider these two together. Executory costs. So these are the costs associated with the ownership and use of the assets. It will be like a tax on the property, insurance on the property, or maintenance on the property, right? So this is considered, it's called the executory cost. It will be recorded, recognized as they incur. And that can be paid by both lessor or lessee, either lessor or lessee. Okay, so that's treated separately. That's not part of the lease payment. Discount rate for ASPE, the discount rate, there's also difference. if you don't know the implicit rate, you have to use your incremental borrowing rate. They don't have option. However, if you do know the implicit rate, you don't automatically use lesser's implicit rate like under IFRS. Instead, you will take the smaller of the two. Smaller the discount rate, higher the present value, right? Smaller discount rate, higher the present value. So the idea is you don't want to understate the liability, because the present value is also used to determine whether it should be capitalized or not. One of the tests is the recovery of lesser's investment, right? So if you use smaller discount rate, is more likely it will be greater than 90%. However, the amount capitalized should not be more than the present value. Okay. Here's an example. Economic life of assets 35 years. Lease term is 10 years. This will be very common for like a lease that's in the shopping mall, for instance, right? Usually it's like it's a more than 3 years, because you don't want to be kicked out while business is going well. So but usually lease term is far less than the economic life of the mall, right? Title to leased equipment will be retained by the lessor. Implicit rate is 9%. Annual lease payment is $15,000. Annuity due January 1st, and the fair value of leased assets is $140,000. So let's look at the test. Transfer ownership? No, it doesn't transfer. Economic life, 10 years is 29% of 35 years, is less than 75%. Present value of lease payments, that's like $104,929 discounted at 9%. That's only 44% of the 240,000 fair value. So that's a lot less than 90%. So this is operating lease. Under SB, it's operating lease. So you don't have to capitalize, nothing on the balance sheet. Now this lease under IFRS will most likely be right of use lease, and it's not short term, and probably it's not low value, right? So you see that will be huge difference in the balance, in the financial statements, mostly in the balance sheet between IFRS and ASPE on this transaction. So for and if this company reports under IFRS, this will be doing. I'm sorry, I'm just okay. When you pay the rent expense, you can do prepaid rent, because the rent is going to pay the January 1st. But if you know, like you know, you're going to do the annual adjustment, so by the end of the year, it will be expense. So that's it. Nothing on the balance sheet. Nothing on the balance sheet. Okay. Let's see. Okay. So there were questions, and people online ask a question, they answer themselves. So for the time remaining, I want to introduce this lease amortization table. It's slightly different from the bond amortization table. So, but it's the same main principle, but it's just slightly different. So that's introduce that. Okay, let me, let me bring one up. And this one is also posted on the Brightspace. And I want to explain to you, anytime you introduce things that's kind of different from the textbook, a little bit, I want to explain it. I don't want to cause confusion. Okay, so before I share that, before I share this amortization table, before I want to share this amortization table, I want to just have one more look at this. So this amortization table is based on this example we had in the on the slides we just looked at. The one that we showed, this is the one on slide 16 and 17. That's the example we used. Okay, that's the example I used. So let's look at the amortization table. For the example on slides 16 and 17. Okay. Okay, so in that example, it was 6 years lease, but the first 4 years, the payment is 5,000 each year, and the year 5 and 6 is 4,500, and the discount rate is 9%. So we already determined that the total present value is 23,769. We already did that, right? So if you look at well, this is not in the middle of, not the beginning of the year, so I just use the beginning of each year to indicate that this does not coincide with the calendar year or fiscal year, just in the years of the lease, okay? First year of the lease, second year of the lease. So the starting value, remeasurement value is 27,769. And at the beginning, the first day of the lease, there's a payment of 5,000. And so the balance becomes 18,769. Okay, there's no payment until the beginning of the second year. And the payment again is 5,000. However, that's a year after initial signing of the lease. So 1 year interest at 9% should have been accrued to this balance, right? So this payment include the payment of that interest of the first year. So and the difference is the reduction of lease liability. Okay, so the lease liability on the first day of the second year in the lease becomes 15,458. Nothing happens until the next payment. And by this time, another $1,391 of interest has been accrued onto the balance after the previous payments. So you keep going in that logic. By the time the 6th payment is made, so these payments are it's different, but that doesn't matter, we treat it samely. And that payment would include the interest accrued on this amount since the last payment. And then the difference between that interest and the amount paid happens to pay off all the balance carried. So this will be the amortization table. Now, when we use this amortization table, we need to be careful that, so for instance, this amount is shown on the beginning of year 2, but this amount is actually the interest expense of year 1, right? Because this is the balance. If you want to, so in the income statement, the interest for year 1, like ignore the fact that this lease straddles 2 years, each year of lease straddle into fiscal year, right? So in the income statement year 1, this is the interest, even though on the amortization table, it shows like is the interest paid in year 2, but it's incurred in year 1. So should be recognized in year 1's income statement. Now, this balance is the lease liability at the beginning of year 1. At the end of the year 1, if you think about the balance sheet, that's not that amount. At the beginning of the end of year 1, that's that amount plus the interest accrued to it. Okay, so just if you keep those in mind, this is great. And so I have this one to add some rows to elaborate on that. So I call it lease amortization table explain. And so I just not to confuse, so the rows I add is instead of the balance at the beginning of each year, I also add a row to show the balance at the end of each year. And I kind of use different shade to signify that's my explanation. Okay, but that helps, right? Just if you find this very confusing, ignore it. But I hope it's enlightening. I hope it like make things easier, not confusing. So at the beginning, we measure, this is the opening measurement, 23,769. And then at the beginning of the year 1 with the payment, the balance becomes this. But that changed before the end of year 1 because you have to accrue the interest on that. So the balance will increase by the interest accrued during the year. So with this, the interest to be reported on year 1's income statement is this amount. And the lease liability is this amount. That's the beginning lease liability balance plus the interest. We can also further take that amount. Remember that current liability and the non-current liability are separated on the balance sheet, just like a current portion of long-term debt is included in current liability and the remainder will be included in non-current liability. So this amount, like 5,000 of that will be paid the next day, right? So this 5,000 is current liability, and the difference between that is 15,458 is non-current liability. Okay, so this the rows at the end of each year shows clearly what should be reported in the financial statement. Okay, and then so this is the same row we have in the original amortization schedule. So the next payment is beginning of year 2, and 1689 of that payment is the interest payment. The difference of 3311 is the reduction of lease liability. So that liability becomes 15,458. That's the non-current liability, right? It doesn't get paid until after 1 year. And that's the amount, this balance is also important because that's the amount the interest will be accrued on. Okay, so year 2's interest will be based on 15,458 at 9%. So that's year 2's interest. And by the end of year 2, the liability balance have increased from 15,458 to 16,850. And then at the beginning of year 3, the payment will pay off the interest for year 2, and the difference will be the reduction of lease liability. So year 3 interest will be accrued on this balance, 11,850. And so you keep going. You get the same end. Okay, you get the same end. So the total payments, you have to look at this total, doesn't make sense because this total is, yeah, that total doesn't make sense anymore because the interest is added twice, right? So the total payment is 29,000. 23,769 is the lease liability. 5,231 is the interest of all 6 years in this lease. Okay, so I have this already on the Brightspace. So I just say this is the kind of official lease amortization schedule. And if you know, you are required to do that, that suffice. But if you want kind of me to explain how to read this, this one help you to understand the first one. You don't ever have to report this one for, you know, assignment or exam, but if it helps you to, you know, interpret this one, you know, refer to this one. Okay, I think that's a good place to stop. That's a good place to stop. There is a quiz based on the topics covered this week. And then we're going to, we don't have a class next week, it's a break. But if you want, you can use the time to review your midterm, and there's a quiz after midterm review quiz, and that will be your bonus point. Okay, now if you wanted, you have any question about midterm, you know, you want to review any part with me, like it just the marking key does not explain enough, please do so before the next class. I want to say that because I don't want to avoid a situation like I already submitted final exam grades and people go, you know what, I have a question about my midterm mark. Let's do it now, and then and get it over with. Okay, so have a good break. See you rested.